everyone, welcome back to our channel and welcome back to this brief video update. We wanted to share with you the recent news about UAE exiting OPEC. It's about the sovereign recalibration of the oil market architecture. Abu Dhabi will leave OPEC and OPEC Plus effective May 1st and gradually raise output. WTI traded above $100 for the first time since early April. The move formalizes a divergence that has been visible for years and accelerates the fragmentation of supply-side coordination. And the UAE's departure is best understood not as a rupture, but as a formalization of long-running divergence with Riyadh over quota constraints and capacity monetization. The cartel's pricing power has already been visibly eroded by the US shale and by Strait of Hormuz disruption, and also by the rerouting of the physical flows around the insurance and security frictions. The exit is a recognition of that diminished level rather than its cause. With this context, let's try and understand what exactly changed. The United Arab Emirates will exit both OPEC and the broader OPEC Plus coordination framework on May 1st, removing the country from monthly quota allocation cycle and freeing it to calibrate barrels on its own commercial logic. The phasing of the gradual increases signals an intent to avoid a destabilizing supply shock while preserving the optionality that quota discipline previously denied. The strategic logic rests on a national diversification thesis funded by maximizing hydrocarbon revenues during a finite window. Quota constraints had become a tax on that particular thesis. This brings us to the market response and the sell-side repricing. Brent traded up roughly 2.75% towards $104. WTI jumped close to 4% and crossed $100 for the first time since April 7th. Goldman Sachs raised the fourth quarter Brent forecast to $90 from $80 and WTI to $83 from $75, citing the extended supply disruption. Spot trades above the revised forecast, and the front of the curve is in backwardization steep enough to signal a market paying up for prompt barrels, consistent with a structurally elevated risk premium rather than transient spike. And then there is also the Strait variable. Tehran has tabled a proposal to halt activities in the Strait of Hormuz in exchange for an end to active conflict and lifting of US blockade of the Iranian ports. It has been reported that the national security team has discussed the proposal, but Washington's posture suggests limited enthusiasm at this point of time. The asymmetry that can be seen out here, Tehran framing the deal around shipping, Washington insisting on the nuclear dimension, is the principal reason that markets are skeptical of an immediate resolution. The risk is asymmetrical in the near term. A deal compresses the premium gradually, a breakdown widens it abruptly. Underwriters are already requiring Iran-approved routes as a condition of war risk coverage, an extraordinary contractual development. And then there are the cross-asset implications also. The Asian importing countries, for example, India, Korea, and Japan, face renewed terms of trade headwinds modulated by the petrocurrency offsets. The investment-grade energy issuers benefit from cash flow tailwinds. Transportation and the airlines' credit face margin compression. Marine insurance underwriters absorb repricing in the war risk premiums alongside claims and routing complexity. The equities show familiar rotation into integrated majors and upstream E&P, while the consumer cyclical and the fuel-sensitive industrials lag. The inflationary tail complicates the duration trade and long-duration growth equity at the moment when central banks in developed and emerging Asia have begun anchoring on disinflation. In closing of this brief update, we can say that several signposts will determine whether the current configuration consolidates into a new equilibrium or whether it represents a transitional phase towards something further still. The first is the response of the residual OPEC Plus membership in the next ministerial cycle. Any signal of looser quota enforcement or accommodative production adjustments by Saudi Arabia would suggest that Riyadh has chosen to absorb the UAE departure rather than escalate. The second is whether any other producer follows the Emirati template. A second exit would shift the analytical frame from isolated divergence to systematic fragmentation. The third signpost is the trajectory of the Iran negotiation. A breakthrough would compress the premium and reset cross-asset correlations towards the less crude-sensitive regime. However, a breakdown would extend the current configuration and accelerate the structural re-rating of energy assets that has been visible in equity, credit, and currency markets over the past several weeks. The fourth and the most slow-moving signpost is the response curve of US shale. which historically responds to sustained WTI above $90 with meaningful capital expenditure cycle. The lag from price signal to incremental barrel has lengthened compared to the prior cycles, but direction of travel is unchanged. Taken together, the UAE exit is best read not as a discrete event, but as a visible marker of a longer process. The cartel that emerged from OPEC plus expansion is being reorganized around the smaller, more cohesive core alongside a parallel architecture in which insurance, shipping, and sovereign capital play roles that original framework was not designed to coordinate. For reallocators, the implication is that energy exposure now needs to be evaluated against a wider set of variables, including geopolitical, infrastructure, and sovereign capital factors that next phase of price formation will increasingly reflect. Now, that's what we wanted to share with you in this brief update video. Stay tuned in for our next update.